Welcome back to The Explainer. Today, we're taking a powerhouse in the healthcare apparel space, FIGS, and running it through an absolute gauntlet of evaluation. You're joining me as an expert investment analyst, and using the uploaded financial data, SEC filings, and earnings transcripts, we're going to perform a rigorous top-to-bottom stock analysis. We'll be pushing FIGS through the legendary investment frameworks of Warren Buffett, Benjamin Graham, and Peter Lynch, alongside a discounted cash flow valuation, just to see exactly what the numbers are telling us. Here's the game plan. We'll grab a quick snapshot of the business, put it under the microscope using the Buffett and Graham lenses, switch over to Peter Lynch's perspective, crunch the numbers in a discounted cash flow model, look at some alternative valuations, and finally, bring it all together for our final verdict. All right, step one, a quick snapshot of FIGS Inc. to see what their business fundamentals actually look like right now.
So as we dive into this analysis, FIGS is trading right around $11.03. That gives them a market cap of roughly $1.84 billion. But here's the kicker. Their trailing PE ratio sits at 49.9. You're basically paying $50 for every single dollar of earnings. Now, for an apparel brand, that is a pretty steep multiple. But is that premium actually justified? We've got to look under the hood.
Well, the sheer velocity of their top line is where things get really interesting. Their growth is just undeniable. We're looking at a massive 28% year-over-year revenue surge, hitting $159.9 million in the first quarter of 2026 alone. To put that into perspective, the industry average is creeping along at around 8%. So yeah, you can immediately see why the market is pricing in that hefty premium.
And what's driving this explosive growth? It's their ridiculously loyal customer base. They just crossed the 3 million active customer mark. Plus, they're operating in a space that is largely non-discretionary. It's a replenishment-driven healthcare sector. I mean, there are nearly 24 million healthcare workers in the US, which means their total addressable market is still expanding. So, the fundamental backdrop here? It's incredibly strong. Okay, moving on to part 2, the Buffett and Graham lenses. It's time to put FIGS through the ringer of classic value investing. Let's kick things off with Warren Buffett's playbook. We all know he looks for a deep economic moat, stellar management, consistent earnings, and low debt. And honestly, FIGS passes several of these qualitative tests with flying colors. They've built an intensely loyal brand, a real moat. Better yet, they've got a pristine zero-debt balance sheet with about $277 million sitting there in liquidity. The tricky part for Buffett, though, is calculating predictable owner earnings. To do that, we kind of have to assume their current hypergrowth phase will eventually cool down into steady, predictable cash flows.
Now, Benjamin Graham's defensive checklist, well, that paints a completely different picture. Graham is notoriously unforgiving. Sure, FIGS has the adequate size and a rock-solid debt-free financial condition. But what about a moderate PE? Nope, it's sitting at 49.9. How about a moderate price-to-book ratio? Also a no. It's up at 4.28. These sky-high multiples would literally trigger an immediate red flag for the father of value investing.
Let's actually prove this mathematically using Graham's famous intrinsic value formula. We take the square root of 22.5, multiply it by the earnings per share, and then multiply that by the book value per share. Using their Q1 net income of $6.2 million, we're making a super conservative assumption of 12 cents for annualized EPS. We then multiply that by their calculated $2.58 book value per share, which comes straight from their balance sheet equity.
And the formula spits out an intrinsic value of just $2.64. Wow. So the bottom line here is that Graham demands a massive margin of safety. At $11 a share, there is absolutely no way he'd touch this stock. It's just way too expensive for a strict, deep value framework.
All right, let's shift gears to Section 3, the Peter Lynch lens. We're pivoting from strict value to growth at a reasonable price. Now, Peter Lynch's very first step is always categorization. Before crunching a single number, we have to ask ourselves, what kind of company is FIGS? Are we looking at a slow grower, a stalwart, a fast grower, a turnaround, or maybe an asset play?
Well, given that explosive 28% top-line revenue growth and an expanding 4.93% market share compared to peers, they are absolutely a classic fast grower. So let's apply Lynch's PEG ratio. If we divide their 49.9 PE by that 28% growth rate, we get a PEG of about 1.78. Typically, Lynch wants to see a PEG of 1.0 or less to call it a strong buy. So at 1.78, it's slightly overvalued relative to its growth. But when you factor in that pristine zero-debt balance sheet, the Lynch lens actually points to a very solid hold.
Okay, time for the heavy math. Section 4, the discounted cash flow valuation. Let's build out a base case DCF. To do this right, we need to hit 3 specific steps.
forecast their free cash flows over the next 5 years, calculate a terminal value using a perpetual growth rate, and then discount all of that back to today using the weighted average cost of capital, or WACC, which is basically the minimum return we expect as investors.
Looking at their Q1 free cash flow reconciliation, you'll notice the free cash flow was actually negative $5.6 million. Wait, why? Well, operating cash flow got dragged down by an $11.4 million increase in inventory. But that's a strategic, near-term investment they need to make to fuel that 28% growth. So to build a realistic 5-year projection, we have to look past this temporary inventory build. We're going to assume a normalized 10% free cash flow margin as the business continues to scale.
So, we ran a sensitivity analysis, and it reveals a lot. If we use a baseline 10% WACC and a very reasonable 3% perpetual growth rate, which makes total sense for a strong brand in a growing market, our fair value lands right around $11.35 per share. Guys, that is remarkably close to today's trading price of $11.03. According to the strict DCF, the stock is basically priced to perfection right now.
Let's zoom out a bit for Section 5, testing these findings against alternative valuation models.
First up, a comparable company analysis. If you stack FIGS up against traditional apparel peers like Superior Group, or even e-commerce players like Wayfair, FIGS absolutely trades at a premium multiple. But hey, context is everything here. Their 3.9% net margin and 28% revenue growth completely blow the competition's 8% average out of the water. So relatively speaking, the market is just rewarding them for vastly superior execution.
And if we look at institutional tracking, Wall Street is incredibly bullish on this one. Based on comparable growth models, the average analyst price target for the next 12 months is sitting at $17.83, with some going as high as $22. It's clear that Wall Street is weighing that aggressive top-line growth much heavier than the currently high earnings multiple.
All right, we made it to Section 6, the synthesis and final verdict. Time to bring all these wildly different lenses together. When you lay all these frameworks out side by side, it is a seriously divided landscape. Strict value guys like Graham, they'd run away at $11.03, holding out for something closer to $2.64. Peter Lynch would hold it, loving the balance sheet but waiting for that PEG ratio to cool off. The DCF model says it is perfectly fairly valued today at around $11.35. And then you have Wall Street and the comparables screaming buy, with a target near $18.
So, blending all these insights gives us our final recommendation. The strengths are just undeniable. Zero debt, $277 million in the bank, and a 28% growth rate fueled by some serious brand loyalty. The risks? Well, that high PE multiple demands absolute perfection, and you're going to see some short-term cash flow bumps as they strategically build inventory. So, at $11.03, FIGS is a solid hold if you're a conservative value investor, but it's a cautious buy for growth investors who are willing to bet this expanding market share turns into massive cash flows down the road.
Ultimately, running this gauntlet proves that valuation is this crazy, beautiful mix of hard math and human assumptions. So, I'll leave you with this. Now that you've seen the deep value math right alongside the aggressive growth projections, at what specific price does FIGS become a buy for you?